Thank you all for joining us on this Zoom presentation today. It is my honor and on behalf of Skylight Financial Group to introduce Todd McGee, Director of Estate and Business Planning for MassMutual. Todd received his associate's degree from Holyoke Community College and his bachelor degree from Northeastern University. After law school at Western New England University, Todd worked at the State House in Boston, Massachusetts, where he was Chief of Staff for the State Representative Michael Cain. While working at the State House, Todd obtained his LLM in tax from Boston University School of Law. In 2003, Todd left the State House and joined the firm in New Britain, Connecticut, where he practiced as a member of that firm in all probate, real estate, and estate and business planning matters. Todd also worked for the law firm of Bacon and Wilson in Springfield, Massachusetts, where he specialized in estate planning, probate, Medicaid, and elder law matters. While at Bacon and Wilson, he published articles for local newspapers and for the firm's website. Todd is admitted to the practice of the law in both Connecticut and Massachusetts, is a member of the Massachusetts Bar Association, Hampden County Bar Association, former member of the Connecticut Bar Association and New Britain Bar Association. Todd is a frequent author for MassMutual newsletter From the Desk of, writing in a great variety of topics on estate planning, estate and business planning fields. Todd also contributes articles in the MassMutual Advanced Underwriter. He is a frequent lecturer and speaker in insurance and financial professionals from throughout the country. He is also an adjunct professor at Western New England University School of Law, LLM program. Todd is the president of Holyoke. I know I'm probably not saying that right, Todd, but Holyoke City Council, elected member of the council and the former mayor of the city of Holyoke. He lives in Holyoke, Massachusetts with his wife, Brenna, and their son, Miles, and two daughters, Maylee and Mac. So Todd, take it away.
All right, thank you very much, and good morning to everyone. Yeah, it's a lengthy bio. I just tell people I'm a really boring tax attorney, but you know, it is what it is. For some reason, I went to school to be a criminal attorney. Really didn't like that, so I had to go to something, and I became a tax attorney. But thanks for having me here. It is, you are saying it correctly. For people who live here, we just don't know how to say our city well. We say it Holyoke. It's spelled, and you're saying it correctly, Holyoke, but once again, it's Western Mass. Also went to school in Boston for quite some time, so I'm going to say things today that you're going to scratch your head and say, what word was that? We're going to talk about sales ideas, IDEA. There's no R, I know. But that's how I speak. So if I say something, you're like, what did he say? Stop me, ask a question. I'm not offended, I'm not upset. It goes with the territory. So if you have a question, don't hesitate to, put it in the chat box or just fire it out there. If you have questions, maybe someone else is thinking it, is afraid, but look, stop me and we'll go through it. With that said, I am one of the attorneys at MassMutual for their estate and business planning, and I express it that way because that's how I was hired, estate and business planning. Over time, they change your titles to advanced sales, advanced markets, what have you. If you see what's happening or follow what's happening in DC, which I do, I'm an elected official, so I have to, there's pretty much chaos as to what's going to happen with the estate planning world. What will ultimately happen, we don't know yet. It's all speculation, but there are going to be changes. What those changes will be then brings us back to the good old-fashioned estate and business planning the way it used to be. Exemptions won't be as high. Certain things that you do for planning might be taken away. And now we have to go back and sit with our clients and go through things to make sure they understand it, because once again, they changed it. And that's really where this PowerPoint or training comes in. Buy-sell planning, unfortunately, I do it on a daily basis. I run a program at MassMutual called the CHBEP program. That's CHBEP, Closely Held Business Evaluation Program. We do an evaluation of businesses to kind of see where they are for buy-sell purposes. What is the fair market value of the business based on tax returns and other things in the way we do an analysis. The real problem is we see on a daily basis that our owners will over or underestimate the value of their business by as much as 60%. Owners will over or underestimate the value of their business by as much as 60%. I'll show you some examples on why that is problematic, but we'll see how, what we can do to fix it. So with that, this is my favorite slide of all the slides you'll get to see today. This is my compliance department. You heard my bio. I am an attorney. I have a degree in taxation. But although I was in the private practice, you are told that you cannot rely on anything I say. And you are encouraged, I love that sentence, you are encouraged to seek advice from someone else who knows what they're talking about. So whatever I tell you today, it's all made up, so we'll move on. That's compliance. All right, I've done my job. All right, what are we going to talk about? Really, this is the main slide that tells it all. In essence, what is a buy-sell arrangement? Well, right away people say, oh, it's an agreement to do this. Stop, it's a contract. It has nothing to do with tax law yet. A buy-sell agreement is a written contract between 2, 3, 4, how many people are involved in it. But as a contract, what do you need to have a contract? You have to have the terms in there. You have to spell out what you're going to do. And ultimately, you have to sign it. And why do I say that? Well, once again, that program that I run, we also review buy-sell agreements. And we take a look at them to see what's going on. Of which I'll always turn to the back page and see, did they sign them? 70% of the agreements that I have read over my tenure, it's been 16 years at MassMutual, 70% are not even signed. So what do you really have? You have nothing. You have a glorified piece of paper they paid a lot of money for the attorney, and if you don't sign it, you don't have a valid binding contract. Now there is a case, I think it's called Seibel, if I always say it right, out of Texas. It was 2 owners of a company, of which I'll say it was Megan and myself. We own the company 50-50. Of which we sit with someone to get insurance to cover the buy-sell agreement. We'll show you how that works in a bit. But we put the insurance in place, and then we go to Al, the attorney at MassMutual. He drafts up a beautiful agreement for Megan and I. That if something happens to me, she's going to buy my interest out from my estate. If something happens to her, I'll do the same thing. Well, lo and behold, we sit with Al several times. And Al goes through it in absolute detail as to how this thing should work. And we pay Al, and we go on our merry way, go back to work, and a week later, I die. Megan gets $2.5 million of a death benefit, tax-free, upon my death, because we're doing a buy-sell. Of which, well, she's grieving. She lost, her friend, her, co-worker, and she takes off. Doesn't even go to the funeral. Takes off. Now, kind of rude of her, but she takes off with the $2.5 million of tax-free money. Of which my spouse says, wait a minute, you're supposed to buy us out for $2.5 million. We want our money. And Megan says, yeah, there's a slight problem. Here's the agreement. Todd and I never signed it. It goes up to the Supreme Court of Texas, of which they review it and they say, you could sit with Al 1,000,000 times, dot every I, cross every T, but until Todd and Megan sign that contract, there's no legal binding rights. And therefore, all it was is a formality to get to there. Megan gets to keep the money. What does my spouse get? She gets 50% of a company, of which there's no owners. I'm gone. Megan took off with the money. So now there's no company. And you have to sell off the assets and take whatever you can get. So this is where these agreements come in to deal with issues. But always remember, you got to sign them because it's a contract. So what is that contract trying to do? Well, it's trying to protect against unwanted third parties. My family's really nice. There's nothing wrong with my family. But my spouse isn't in the business. Neither are my kids. They're young. Of which, if something happens to me, Megan doesn't want to have to work with my family, or my spouse wants to do something, or she wants money, and Megan's trying to run the company. They become unwanted because they're not really involved in the business. Not that they're not good people, but they're not involved in the business. So we want to kind of transition away from that and allow the owner or owners to keep going forward. It provides a market. Who does it provide a market for? My spouse, my family. In essence, I own 50% of a company. If no one's buying me out, what do they really have? Nothing. So the agreement, the buy-sell arrangement says, if something happens to me, the other owner doesn't want to deal with the surviving members. Therefore, what they can do is buy them out for a fair market value. So now we know with absolute certainty, so long as we do everything correctly, if something happens to me, my 50% interest is worth $2 million, $3 million, of which the other owner or owners are agreeing to buy me out for that value, not a lower value. So it locks in to make sure I know what I need upon my passing, that my family's taken care of. It may, and I put that in there, help peg the estate tax. Just because we're doing a value or doing a buy sell, you have to know what the value is in order to help take that value and apply it towards your estate tax. So what we see commonly as an error in the planning process is, hey, look, I have a company, they're worth $5 million. Well, is that truly the value of the company? Is it 10? Did they undervalue it? And if they did, we should, when doing a buy sell, get a true value as to what the business is, because once we know that value, we now can transition from business planning to estate planning. Todd, you have a business, it's worth $10 million. You have other assets, add it all up, you're worth about $15 million. Well, depending on what happens with the estate tax rules, I may have an estate tax problem if I pass away. Well, we just transition from business planning to estate planning. Prevent transfers from S corporations to ineligible parties. Here's the rule. I'm an owner of S corp with Megan, with Dale, whoever it is, of which those are eligible people. They're not a problem. Why transition some of my shares to my trust? Wait a minute. Is that trust drafted correctly as a grantor trust in order to own shares? If not, I could blow the S corporation status. I transfer my shares to a family limited partnership because I want to do some estate planning through that type of vehicle. Well, family limited partnership or an LLC can't own S corporation shares. Did I just blow the status of the company? So you got to be really careful about moving things around. And then finally, financial dependency. I was working in the company. I was 50% owner with Megan. I was taking home $100,000 a year. I'm gone. Where's that money from my family going forward? Where's the income replacement? Well, upon my passing, Megan's going to buy out my interest for a fair market value. That money coming in goes to my family. That's what they're going to use to then, in essence, cover the loss of income or financial dependency going forward. So buy-sell arrangement, although it is just a contractual right, deals with all these issues. And it's not just focusing on it as a contract or buying someone out or transitioning the business. It then comes around to deal with income replacement, retirement planning, estate planning, whether or not you have an estate tax, how are we going to do the planning to then transition the business to kids who are in the business and those who are not. So in essence, when we start dealing with buy-sell arrangements, you have to think of it as a circle. In essence, you have the buy-sell portion to deal with, then you have the retirement portion, and then you have the estate plan. So it's one circle addressing all three issues at the same time, but you have to take it in pieces to make it understandable to everybody. With that, here's the type of buy-sells that you'll see in the industry. You'll see the entity buy-sell, cross-purchase, wait and see, that's my favorite, or really the attorney's favorite, and I'll tell you why later. And then you have a trustee cross-purchase. Now, here's my question. Entity purchase, stock redemption. What's the difference? Nothing. It's just that entity is for your LLCs, your partnerships. Stock redemption is your C Corps, S Corps, because they have shares in the corporation. Don't get lost in the shuffle. Some people are like, oh my God, what's up? Is there so much? But no, there's no difference. It's just one is an entity for partnership rules, one's for corporation rules. So with that, what do you commonly see for buy sells? You will see the entity and the cross purchase. Those are the standard ones that you'll see out there. And then you'll see the hybrid ones that we'll get to in a minute. So really, I put a cheat sheet together, the next few slides, kind of telling you the difference between the most common two, which then is, okay, the structure of them and how they work. Well, let's take a look from the left and then go to the right. Here, you have entity versus cross purchase. Well, who is doing the purchasing if someone leaves, whether they die, become disabled, or retire? Well, the corporation's doing the redeeming, the purchasing. If it's a cross purchase, it's the other owners. So once again, go back to my example. Megan and I own a company 50-50, 60-40. It doesn't matter the percentage, but we're the only two owners. Well, if you're doing an entity buy-sell, if something happens to Megan or I, and I'll do it to myself, I die. Well, the entity is going to redeem my 50%. Well, if it's a cross purchase, she's redeeming what I owned and vice versa, hence the cross. Well, who's the seller? Well, in both cases, it's the estate. Someone died or retired or become disabled, they're selling out. Well, that really gets into then who owns the policies for life insurance purposes or DI purposes to deal with that buyout. Well, once again, the corporation, entity buy-sell, cross purchase, it's the other owners, which then leads to the first biggest question. Why would you choose one over the other? Or what makes a difference between the two? Number of policies is the first issue. In an entity buy-sell, it's one policy per person. So there's 4 owners. It's Megan, myself, Dale, and Al. We're the owners of the company, 1/4 each. Well, that would be 4 policies for an entity buy-sell, 1 policy per person. Company is owner. Company is beneficiary of the policies on us. So if, once again, something happens to me, the death benefit or the DI proceeds go into the entity. The entity then takes it and gives it to the estate as the seller to then do the buyout. Well, with a cross purchase, it's multiple policies, which then, if you were me, as I was telling the people earlier, I wasn't the greatest student in high school. I walked the halls well. I could tell you, how to get around, getting caught. But, you'd skip classes like algebra. And algebra teaches you, well, how do you know how many policies you need in cross purchase? I did attend that class. It's X times X minus 1 yields a total number of policies. Don't do that to a client. I did it and they looked right at me and said, excuse me? And you're like, oh, okay, sorry. So what you really do is make it fun. Take the total number of owners that you have and take the number before it. That's how many policies you need. So give me a number. It's 5 owners. What comes before 5? 4. 5 times 4 equals 20 policies. I have 4 owners. What comes before 4? 3. So I need 12 policies. Right away, you can see, well, entity buy-sell is a lot easier. 1 policy per person. However, cross purchase, the more owners you have, the more policies you need to own. Because in theory, what's happening is, with the 4 owners in my example, I own a policy on Megan, Dale, and Al. So I own 3 policies, of which they own them on me. So hence why you get multiple policies. Which then leads to, well, and this is my favorite question that came up yesterday in the training, are premiums deductible? No. Entity buy-sell, cross-purchase, premiums are a non-deductible item. Of which I had a person look at me yesterday in a training and say, well, that's not true. You can get deductions. No, you can't. 264 of the code section can't be any more clear other than it's one sentence that says life insurance premiums are a non-deductible item. Period. End of story. Where people get caught up is if I do a cross-purchase and I have a C corporation, it's only with a C corp. Even though I own the corporation 50-50 with Megan, or I own it 100%, with a C corp, it's its own separate entity for tax purposes. It's separate from me. So although I own it 100% or 50%, I'm viewed as an employee, even though I am the owner. Therefore, with a C corp, the C corp could bonus me money to help me pay for the policy that I own on Al or Dale or Megan. Well, that bonus is a deductible item because it's wages. It has nothing to do with the premium. The first transaction is I took a wage, got a deduction for the company, and then took my after-tax dollars and paid for the policy to do with the cross purchase. Once again, that's not saying premiums are a deductible item, but saying a wage is. You got to separate the transactions. Finally, our last 2 things, death benefit is tax-free on both sides, so long as we don't violate transfer for value rules. I'll explain that in a minute. But here's the big one. Why do people really choose one over the other? Well, I just showed you one case, multiple policies, simplicity. I'll go with the entity. Well, here, for the surviving owners, if you do an entity buy-sell, it says there's no increase in basis. If, however, you do a cross purchase, it says basis is increased by the amount paid for by the deceased shares. Well, what does that mean? What are they saying here? Really what it is, it's step up in basis. In essence, I own a policy on Megan, she owns on me in a cross purchase. I die. She gets the $2.5 million in my example. She goes to my estate, she buys out my 50%. Her basis in the company just stepped up by what she paid, $2.5 million. So now she sells the company 3-4 years down the road, her capital gains exposure has been minimized. If I do the entity buy sell, the entity's doing the redeeming, not the other owner. So the company gets a $2.5 million in my example, they buy out my 50% interest. What is Megan's basis in the entity? It's still what it was when she started the company with me. It didn't increase by that $2.5 million. So once again, if she sells the company 3 years after my death, she'll have a large capital gains exposure. So a lot of people will run to a cross purchase because they want that basis increase. Well, here's the problem. There's 4 owners. Are we really going to have 12 policies? Probably not. Here's another problem. I'm 60. Megan's 30. She's got to do a cross purchase, of which she's owning a policy on me based on my age for insurability purposes. I also smoke. I don't know what a gym looks like other than driving by on the highway and beeping at it and waving at the people inside and laughing at them. I'm almost borderline uninsurable. Well, she owns the policy on me. She's got to pay for it with her personal checkbook. So the premium on me for a DI policy for life insurance is $10,000 a year. Well, she's younger. She goes to the gym. She doesn't smoke. The policy on her is $1,000 a year. I'm happily going to pay the $1,000. She's got to pay the $10,000. So now age, health, insurability, total number of policies have an impact on determining the type of buy sell that you're going to look to, entity versus cross purchase. But a lot of people want to run to cross purchase because of the basis increase for our surviving owners, but not always does it work. You have these things for, do I have for an entity buy sell, an issue with the redemption being taxed? So that's it says 302, 303. I don't need code sections. Impact with attribution. Really, if I'm doing an entity buy sell in its simplistic form, and it's between family members, it's my kid, I want him to take over the business, but I don't do a full redemption. I try and, do part gift, part sale. Well, really what happens is if I don't do the full redemption correctly, then under these code sections, it could be viewed as a dividend distribution. You say, oh, who cares if it's a dividend distribution? Dividends are taxable, non-deductible. So I want to avoid that when I'm doing if I'm doing a buy sell, because in most cases, if I pass away, the death benefit comes in tax-free, we do the redemption, the estate doesn't have a taxable event, and neither does the surviving owners. Well, if you violate these rules and it's viewed as a dividend, now they have a taxable event. Not really your issue to watch out for. It's the attorney when drafting the buy sell to make sure you don't fall into the trap with the 318 attribution rules into the 303, 302 rules. The last one is really one that is a big one that you have to watch out for is transfer for value. If I transfer a policy, it's only about life insurance, for any type of consideration whatsoever, then we make what was once a tax-free death benefit taxable as ordinary income. Once again, taxable as ordinary income. So think about a buy sell where, once again, Megan and I own policies on each other. We violate the rule some way, shape, or form. I'll show you examples in a minute, of which instead of her getting the $2.5 million or $2 million of death benefit, she's now got to pay taxes on it. So instead of having $2 million to buy out my family, she only has 1.5. She had to pay taxes. Well, she's obligated to pay the 2. She just had to pay on taxes on something she shouldn't have to pay taxes for, and now she has a shortfall in order to do the buyout. This is where you got to be really careful with these rules, because where life insurance is a nice feature to help with a buy-sell process, if you mess up a rule and it's really Internal Revenue Code 101, then you have some serious tax issues. With that, I did tell you, and I'll go back to it. With an entity buy-sell, you do not get a step up in basis. I told you that for your surviving owners, right? It's right there. It's got an asterisk to it. I lied. Here, you can do it with what we call our partnership rules. In essence, it's only with your partnership rules, 705A1B. And why I'm not a big code section person, but the reason I put it in here is if you look at the code section, it's divided up into rules in the sense of in your 700 areas, that's your partnership rules. So if you were to tell me, hey, I got a company, they're a partnership, I'm going to say, oh, you can do an entity buy sell, of which the company is the owner and beneficiary of a policy. And if someone dies, upon that person dying, me again, death benefit comes into the entity, gets allocated out to the surviving owners. Here, Megan in my example again, she gets the death benefit and goes and does the buyout. So it's an entity buy sell with a cross purchase field. And she said, oh, perfect, let's do that. And we set it up, and then I die, and it turns out that we were really an S Corp or C Corp. Obviously, that code section is not going to apply anymore because we're not partners in a partnership. Oh boy, now we got a problem. So if you are partners in a partnership, my favorite one is your LLCs. Your limited liability companies are a creature of state statute, of which you get to check a box. How does the LLC want to be taxed? It can be taxed as a partnership, an S Corp, or a C Corp. So of which, if I go out there and I say, hey, I have an LLC, and most people believe the LLCs are partnerships, got to check. Because if I do this type of planning and say your partnerships and you have checked the box being S Corp, I don't get this type of luxury in the planning process. Any questions on that? That one's kind of a tricky one. If I tell you a rule and then I take the rule away from you. All right, well, I'm going to do it again. Here we go. Here's your rule. So transfer for value, I told you earlier, if I mess it up, I'm taxing you. Really, the code section says, hey, life insurance is there and the IRS doesn't want to tax a grieving family member. They want death benefit to come in and take care of them. But seeing how we can move policies around for other than estate planning and grieving families, we can do it for business planning, income replacement, a lot of things where life insurance fits in other than your typical taking care of the family. Well, they come out with rules, of which they say, hey, look, under 101A, death benefit is tax-free. But under 101A1, if you violate that rule, and you transfer a policy for any type of consideration whatsoever, doesn't even have to be cash, a mutual promise for a benefit, then the death benefit becomes taxable as ordinary income, unless you fall within an exception to the exception under 101A2, which says, hey, even if you violate the rule, but you violate it by giving it to the insured, to the corporation, between partners in a partnership, or a gift, then you're okay. So I violated the rule, but I fell within an exception, so I don't have to tax the death benefit. Well, look at this very long list, and I'm being facetious. 1, 2, 3, 4. That's it. Those are your exceptions. So the first one's easy. Company owns a policy, or Megan owns a policy on me. She gives me my policy back in exchange for buying me out. I didn't die this time. I just retired, so she gives me my policy back plus cash to buy out my 50%. Well, in essence, that's a transfer for value. I'm transferring the policy as part of the buyout. So the death benefit should be taxable. You transferred it to me, the insured. Number one exception to the rule. I die, the death benefit goes to my family, tax-free. Well, if I transfer up to the corporation where I'm an officer or shareholder, of which to help do that entity buy sell, that's an exception. Between partners in a partnership, I own my own policy. I give it to Megan. She owns her own policy. She gives it to me. We do a cross purchase buy sell. That's an exception. What didn't I say within that exception? Transfers between shareholders in a corporation. Once again, remember 705, I talked about using partnership rules. Here, transfer for value, partnership rules. For whatever reason, when they came out with the rules, they don't mind the partners and partnerships. They give exceptions to it. They don't like shareholders in a corporation, so there's no exceptions to it. Megan and I are owners of an S Corp, a C Corp. She gives me her policy, I give her mine. I name her as beneficiary of my policy. She names me as beneficiary of her policy to do that cross purchase, just through a beneficiary designation. All those are a violation of this rule. I pass away, the death benefit to her is taxed as ordinary income. Now you might say, well, how would they know? How would they know? Well, when you transfer a policy on the form, it says, are you transferring the policy that's subject to transfer for value? Yes or no, you got to check the box. Which then you might say, well, what if I lie and I don't check the box correctly? Well, fraud's bad. And if you don't mind going to jail and having 3 squares a day, it's okay. You can do that. But really, they put the rules in place to tax you and then penalize you, go to jail. So you don't want to commit fraud. I mean, it is the ideal of planning, but I just suggest don't do it. But here, my last one and my favorite is gifts. Of which, forget about the buy-sell world. I'm dad. I own 2 policies. Of which I don't want them in my estate, because you're going to hear this question a lot. I don't want them in my estate for estate tax purposes, so I'm going to give them to my daughter, Megan. Of which the first policy, I put in $10,000 of premium. I took a loan on the policy, though, of $8,000, and I give it to my daughter. The second policy, I put in $20,000, and I took out $25,000 of a loan, and I give it to my daughter. In both cases, I've given her a gift of both policies. Do I have a transfer for value in any one of those issues? No one's going to answer? Okay, I'll answer for you. In essence, this is where in the industry, people get lazy. And what I mean is they'll say, hey, it's a gift. If you make a gift, that's an exception under 101A2. No, it's not. 101A2, if you actually were to read that code section, says the basis in the hands of the transferee is the same as that of the transferor. I'm not making it up. If you pull up in the code section, that's the exact sentence. I am truly that boring. I read the code section to my kids at night to put them to sleep. Yes, I do. But I hope that they can do taxes when they're older and start paying me back. That's my theory. But here, that's what the code section says. Does it say at all? Gift. No. Basis in the hands of the transferee is the same as the transferor. It's a basis issue. In the first policy, I put in 10, took out 8. What's my basis going to my daughter? 2. That's a gift. That's okay. I put in 20 in the second policy, took out 25. What's my basis in policy number 2? None. -5. So in essence, in the second transaction, since no basis carried over, upon my passing, the death benefit to my daughter will be taxed as ordinary income. So if you ever have someone ask you, hey, look, I have a policy, I want to give it to my child, I want to get out of my estate, I don't want to do a trust. First question, is there a loan on that policy? No, no loan. Go ahead. Not a problem. Yes, there is a loan. Stop. Second question, does the loan exceed basis at the time of transfer? No. All right, go ahead. Wait a minute. Yes, it does. Stop. Strike 3. Pay off some of the loan, get basis back in the policy. Now you can transfer that policy to avoid the issue. All right. So what did we talk about quickly? What are the pros and cons? Well, if I'm doing an entity, it's the simplest of them all. 1 policy per person, company is owner and Benny, company pays a premium, there's no deduction. God forbid someone dies, death benefit comes in, you buy out the other party, easy. Couldn't get any easier. The other issue is, well, if I have different types of products out there, there's term products, there's ULs, there's variables. If there's a whole life product, which has a cash value building up, that's an asset to the company. They can use it however they want. So that's a benefit to them. Age, insurability, since the company's paying for it, we really don't care. That doesn't factor in. Really, the main thing, the disadvantage is I lose that basis increase for the surviving owner. Well, okay, well, what's the pros and cons to a cross purchase? Well, they're right here. I didn't make it up. Well, first one is I get that basis increase. So if, God forbid, person dies, I'm going to buy them out. My basis in the company steps up by what I pay. If I then sell the company, I'm helping avoid my capital gains problem. There's no AMT. AMT is pretty much gone because of the 2017 Tax Act. There's no attribution. The real one is number of policies. The more owners you have, more complex it is. Transfer for value problems, if I start moving the policy around, I can make the death benefit taxable. All right. So with that, here's our little Q&A. For a cross purchase or an entity, who is the purchaser of the deceased shareholder's interest in a cross purchase? Well, that's the other owner. Is it more convenient when you have many shareholders? What could you do? Well, you could do the entity buy sell. Once again, if they're a partnership, if you have many owners, you might want to do the partnership and you still get the cross purchase feel. Under which arrangement is a premium deductible? Oh, that's a trick question. Neither. Premiums are non-deductible anywhere. How many policies do you need for a cross purchase with 5 owners? I already gave that one. I shouldn't use that example anymore. 5, what comes before 5? 4 equals 20 policies. All right, here we go. All right, here is my favorite, wait and see. See them all the time because that's what I do for a living, review buy sell arrangements. And I used to draft these. Why is this a favorite for attorneys? Anyone? Take a guess. No one? All right, everyone's bashful today. All right, why billables? It's all about the billables. I'm not even kidding. A wait and see arrangement is really a triggering event. It's a options contract. What do I mean by that? Well, here you have your two owners, A and B, of which it'll say, hey, look, upon someone dying, A, never be A in a fact pattern, you always die first. Well, the option will go to the company. Company, you have the right to redeem Todd's interest. You have 30 days to do it. If you don't do it, that option lapses and it goes over to option 2. Who's option 2? That's the other surviving shareholder or owner. They then have 30 to 60 days to exercise the option to buy you out. And if they don't do it, it goes back to a third option, which is the must. And it goes back to the entity in most cases. It could be reversed. It could be first as the owners, then the company, and then back to it. So however you want to do the options, this is really what you're doing. So you're saying, hey, Todd died. Company, do you want his shares? Yes or no? It lapses. Hey, owners, do you want it? Yes or no? Back to the company if no one exercises their options. Now, right away, someone might say, that's a little confusing, complex. I can understand why you charge for it. Why the heck would you do it? Why? Well, in a simplistic world, it was Megan and I, 50-50 owners. We really don't need to wait and see. I'm either doing cross purchase or entity buy sell. Change the dynamics. It's me, Megan, but now my kids are working in the business, of which I want my 50% to go to my son and daughter who are involved in the business. If I commit to a cross purchase with Megan and I do die, she buys out my interest, she's 100% owner. What do my kids get? Nothing. Same with an entity buy sell. So now as things start to develop over time and it's no longer just her and I 50-50, maybe I've given some of my shares to my son, 5%, 10%, my daughter, 10%. So I went from a 50% owner to a 30, and my two kids now each have 10. Megan still has her 50. Well, Megan really doesn't want to buy out my interest because she's starting to get ready to retire too. Well, wait and see. As things develop and we start changing the ownership of the company, if God forbid I die, well, option company, do you want to redeem some of my shares and then kind of phase me out? Or let it lapse, and then Megan, do you want it? Well, I don't want to buy the whole 30% of what Todd had. I'll just take 10. And then I'll have the kids do in proportion what they have, buy out that interest well. So we're trying to see what the future holds and giving flexibility as to who our owners are at the time. So wait and see is a really good flexibility type buy-sell arrangement to deal with the unknowns. The real problem that I see in the industry is not all attorneys specialize in this type of planning. And let's face it, everyone has the attorney. It's a family friend who is really good for whatever issue, doing a trust, but they have no experience for buy-sell planning. But that's the family attorney, and that's who they want to use, of which they cut and paste things. We're notorious for it. We cut and paste, and we put it in option 1, and we put it in option 2, and then lo and behold, I've seen it, option 3 is missing. So you have an option, you have a second option, no one exercises their option, and option 3 is missing. Now what do? The buy-sell is broken. So you gotta be really careful with these agreements. You have to draft them correctly in order to make it work. And if you don't, you can run into some serious problems for the family. The big question that comes up later is, well, if you're putting insurance in place in order to deal with the buyout, who owns it? You got option 1. Does the company own it? No. There's another option. The option 2 is for the other owners. Do they own it? Who owns it? Always look to the must. The must is your answer. Here, the entity is obligated to do a buyout if everyone else fails. So you want the insurance in the entity if the must falls there, which then leads to the final question. Well, Option 1 fails. They don't want to do it because they want to pass to option B to get some of the interest to the kids and some to the other owner. They're not going to redeem the whole thing. Well, they don't have any money. How do they do it? The company can always do a distribution out or a loan out to the other owners to then have them have money to do the purchase. But you got to make sure you protect the must feature, because if for whatever reason, and stuff happens in the future that we don't know about, there's an obligation that's afforded you, you want to have the insurance coverage there. All right. The last one that you'll see out there is your trustee type of planning. This is where, hey, I want a cross purchase, but I don't want multiple policies. Enter the trust world. In essence, the company is going to set up a trust, which is really an escrow agent to own a policy on everybody. So our escrow agent trustee is going to own a policy on A, B, C, and D, not 12 policies, of which A, B, C, and D are going to give money to the escrow agent trustee, and he's going to, or she's going to pay for the policies and just manage them. If someone dies, once again, A dies, death benefit goes into the escrow agent's hand, and he or she is obligated, pursuant to the buy-sell, to give the money out to B, C, and D. And then they proceed with the buyout. So you're using an independent party, they call it a trustee or an escrow agent, to manage the policies, to then get the death benefit to the surviving owners to do the cross purchase. It's fine. It's more of an expense. It's used a lot, not so much for, cross purchase, but for security purposes. I don't want, no offense to Megan, I don't want her owning a policy on my life. I'm walking down the street, I'm a little nervous that buses come by and I might fall in the street somehow. Well, I'm nervous that someone owns a policy on me. I can run to a trustee to own the policies, not because, I'm worried about setting a basis, but more for management of the policies and make sure things are done correctly. You got to pay for it though, because they're independent. A, B, and C, D cannot be the trustees in a trustee cross purpose. So an expense. The biggest issue though for here, it goes back to the last slide, I skipped it on purpose, transfer for value considerations. Once again, I told you about that rule. Well, here, remember in a cross purchase, traditional one, I own a policy on Al, Megan, and Dale. I die. In a traditional cross purchase, the policies that I own on them, they're going to take, because they're going to want those extra policies that I had, because they went from a 1/4 owner to 1/3. They now need that insurance coverage to deal with the growth of their ownership. Well, that is a transfer for value. And that happens in a trustee cross purchase, even though you have one policy per person. So if I have a trustee cross purchase with S Corps or C Corps, I run afoul of the rule on the second death. So you just got to be careful there. All right. What does happen in order to avoid corporations and transfer for value? Well, what you can do is you can set up a separate entity, your partnerships. In essence, we see this a lot with our dentists and doctors. I have an S Corp. I don't want to do an entity buy sell because I have a policy inside the entity. And I'm not a good doctor. I cut off the wrong leg sometimes. I've got problems. I get sued. Well, the life insurance inside the entity is an asset in the lawsuit. So what I do is I set up a separate partnership, of which that partnership owns other assets like real estate or something, and it owns the policies on the other doctors, dentists. Since I'm using the partnership for buy-sell purposes, I've never run afoul of transfer for value because we're partners in a partnership. But two, I'm sheltering the policies for creditor purposes. And then ultimately, I'm using that partnership rule, the 705 rule, to say upon someone dying, we're going to flush the death benefit out to then do the buyout and get your step up in basis. So here we see a lot with corporations, once again, your dentists, doctors who are subject to lawsuits and stuff, setting up separate partnerships to do a buy-sell to achieve all the benefits that we talked about. Why is this here? What is disability insurance buy-sell? Well, in essence, when looking at a buy-sell, you'll see the three standard triggering events. Death, that's easy, someone dies. Disability, or retirement. Well, retirement's kind of easy too. I'm retiring 62, 65, buy me out, I'm gone. What is disability? I have seen disability never defined. I've seen them try to define it. I've seen them butcher it in every way, shape, or form. Disability is someone's not coming back to work. When? How? How long? Disability is 3 months, Todd's not working there. Well, I'm driving my bike down the street, I'm hit by a car, I'm not dead. I'm in rehab for 6 months, but I'm going to come back to work. I'm the owner, it's my company. Oh, we're going to buy you out, you're disabled. So disability is a triggered event. You got to look in a buy-sell arrangement to see how they define it. My favorite way to define it is, use the policy. If I have a DI policy, they define what disability is. So when someone is disabled, the policy will trigger and then start to pay out. Why is it important? Disability is always a triggering event. I think I've probably only seen it once, not in a buy-sell agreement, once of all the ones I've read thousands. Well, since it's a triggering event, it's there because we want to make sure we don't want people, sitting at home disabled, never working again, but receiving a check. We see businesses fall apart for that, even great friendships. Well, okay, then what do we do? Well, we're going to buy someone out not because they died or retired, but they're disabled and never coming back. So we're going to buy them out for fair market value. Well, how do we pay for it? I have a term policy to do the death buyout. Well, if I have a DI policy, the policy kicks in for the disability to then give me the money to start buying the person out during their life for disability purposes. So in essence, it's another way of buying out a person because of a disability occurring. The real issue here that people forget about is, even though the benefit comes to me tax-free, because I paid for the DI policy and now I'm getting it in reimbursement, I'm buying out the other owner, Al. Al's disabled, I'm buying him out. He's selling his 50% to me. Al will have a taxable event, capital gains exposure. Remember, Al died, his family sold the interest, they got to step up in basis, they didn't pay any taxes, the estate pays no taxes. Well, Al's alive, not well, but he's alive, I'm buying him out, he's selling his interest. That means he has a capital gains issue. All right, advantages, in essence, we're buying someone out, we're putting the product in place to help them achieve it, and it helps define what DI is. All right, for the last few minutes over here, some sales ideas. I know, there's no R. Anyways, we'll move on. Here we go. One-way buy sells. Everything I've been talking about is Megan and I, 50-50 owners. It's just me. I own a company. There's many out there. I'm the sole owner, of which I have key employees, Megan or Al or someone's a key employee. Megan's my daughter. She's in the business, but she's a non-owner. Well, if I die, the entity shuts down. There's no more owner. Well, that's not fair. I have 10 employees. Megan's my daughter. Megan's a key employee. I could enter into a one-way buy sell. In essence, I'm finding a willing buyer to buy out my interest for its fair market value. If I die, there was no buyer, what does my spouse have? Sell off the assets. Assets minus liabilities yields a liquidated value, very small number. Well, I have a willing buyer to buy me out. The company's doing well. While I'm alive and well, the fair market value is $3 million. Well, here, Megan will be the owner of a policy on me. So Megan's the owner of the policy on me. I can bonus her money to help pay for it. So I get deductions for that because that's wages. She owns the policy. You enter the one-way buy sell. I die. Death benefit goes to her. She had no ownership yet in the company. Well, now she's 100% owner. And she keeps the company running. Well, my family's taken care of because she just bought out for fair market value, not a liquidated value. So one-way buy sells, we see a lot of them. It is many times with family members like kids that are involved, of which we'll see a blend of it, part gift, part sale. Hey, look, I don't want my kid to have to buy out $3 million. So what I'll do is I'll gift them some shares in the entity and then have them own a policy on me to then do the rest of the buyout to take care of mom because I'm gone now. So there's ways to blend it. Just understand a one-way buy sell is you only have one way of doing it. I'm not going to buy them out because they have no interest yet. They're buying me out when that triggering event occurs, and usually it is death or retirement, not so much disability. Cross purchase with trust. This is your estate plan. Remember I told you earlier, hey, I'm doing buy-sell planning. Well, you really should be talking about retirement planning and estate planning. Here, my favorite is, traditional A and B, own a company 50-50, of which the company's fair market value is, call it 20 million. Well, right now we all know, or we should know, that the exemption over our head, everyone's got an exemption of $12 million floating over your head. So if you're single and you add up all the stuff you have and it's $8 million and you die, well, you haven't exceeded 12, so therefore there's no federal estate tax. Yay, you win. Well, you die and it's over 12, or you have 15, well, that $3 million excess is taxed at 40%. And it's due in 9 months, you got to pay it. Well, here, look at our simple example. A and B own a company 50-50, $10 million each. Well, there's no estate tax. I'm married. My wife has 12 million. I have 12 million. That's 24 million. We're protected. No federal estate tax problem. Well, B dies unexpectedly on me. I went from a $10 million ownership fair market value to instantaneously 20 million in a buy sell. Not uncommon. So now I have a potential federal estate tax problem. Knowing that going in, and here's the real trick, January 1st, 2026, your estate tax rules sunset. You no longer have a $12 million exemption. It goes in half, goes down to about 6.5. So in my simple example, I already have a federal estate tax problem. If B dies, I have even more of an exposure into their estate plan. In essence, I'll set up my ILIT. My ILIT's going to own my irrevocable life insurance trust. It's going to own a policy, not on me. It could. It's still going to own a policy on me, but it's going to own a policy on the other owner. Here, once again, it's Megan and myself. She's going to set up her irrevocable life insurance trust, which is going to own a policy on me. Hence the cross purchase. So instead of her owning it on me, her trust owns it on me. Of which never be A in a fact pattern. That's me. I died. Well, the death benefit doesn't go to Megan. It goes to her trust. Well, that's $10 million in there, my simple example, tax-free. Well, the trustee, pursuant to the buy-sell, is obligated to buy out my 50% from my estate. So the trustee goes and buys out my 50%. That 50% doesn't go to Megan. It goes inside her irrevocable life insurance trust. My family's taken care of. I'm now out of the picture. So is my family. Megan owns 100% of the company, but she owns 50% herself, the 10 million. 50% is inside her trust, the other 10 million. Is that 10 million inside the trust in her estate for estate tax purposes? The answer is no. So what we effectively done is we've taken half of a value and sheltered it into a trust, of which who really is the owner here? Megan. She has 50% ownership in the company. Her trustee, which is probably kids or attorney or something, is the other trustee. She runs the company. But she effectively took 50% of the value of that company and sheltered it in a way that when subject to her to a 40% tax. That's where the trust world really comes in to help us do the planning. Seems real simple. It gets complex on how you do it, but in simplistic form, I can move things around, still keep control, but not have the 40% liability. All right, kind of mentioned it earlier between your dentists and doctors, partnerships among shareholders. Once again, in essence, if I set up a partnership in order to deal with S Corp or C Corporation owners, the benefit is I'm getting creditor protection through the partnership rules. I'm still getting that step up in basis, and I avoid all these other things like AMT and everything else that normally you would see in a traditional entity buy sell. Also, I avoid transfer for value because we're partners in a partnership. So by setting up that partnership, I've effectively done a buy sell that was more like an entity, but gave me cross purchase feel, and I avoided all these other negative issues. The real problem with partnership buy sells is some people just set up a partnership to own life insurance. Well, let me take a step back. If you ever taken partnership law, not tax law, just regular law, it's defined by state statute, which says 2 or more people engaged in a business for profit are partners in a partnership. I don't have to do any filings with the state. So, Al and I have money, I give it to Al because we're going to go out and sell this estate planning software, and we start going out and trying to sell it, and money's coming in. We're doing well. People are buying our stuff. We did no filing with the state. We're 2 or more people engaged in the business for profit. Well, since we're partners in a partnership, you really have to do formalities of setting up an operating agreement and everything else if you want to keep the partnership running. Well, okay, I could set up a partnership. I could set up an LLC, check the box and call it a partnership, and then throw life insurance in there. Well, what am I really engaging in for profit if it's just owning life insurance? You're not. And that's where the IRS can come back and actually shut down the partnership on you and say that it has no true intent. And therefore, all the benefits that it's going for is lost. Always remember, if I'm trying to set up a partnership to do this type of planning, you have to have something else in there. And that's why I always say when you're dealing with dentists and doctors, they already probably have an LLC set up as a partnership to own the real estate that they're renting, or their store's already in it and they're renting to themselves. If that's the case, do the buy sell through there, because it does have a true business purpose. It's running real estate, rentals, and everything else, and it's a management technique. Adding the policies is just an after. All right, so with the time left, so I'll leave it for questions. The main thing is buy sell planning. You got to keep it simple. It is a contract. You got to make sure the contract is signed. But there's ways that we can do it: entity, cross purchase, wait and see, trustee, many different ways to do it, depending on, or even a one-way buy sell, depending on what we want to try and accomplish. But just remember, when it comes to buy sells, you should always review them probably every year and a half. Why do I say that? I have seen buy sells come into me that are 10, 15 years old. And it says Todd, Megan, Al, Dale are the owners. And I'm reviewing it. And I said, okay, well, tell me a little bit about the owners. Well, Todd and Megan are gone. Todd died 5 years ago. They bought out his interest. Megan retired 4 years ago. I'm like, they're still in the buy sell. Well, yeah, I guess we have to amend that then. Yeah, because they're gone. So you just got to, reviewing them, making sure that they're in compliance with who the parties are, as well as the values. Companies grow in value. If I were to put insurance in place to help deal with the buyout for the family members, but I never review it again, and I had a $1 million policy, but the fair market value is now 2, then I don't have enough insurance to cover the buyout. So constantly reviewing these things helps us make sure we're not missing something. With that, you don't break up into groups here. Here's the real thing. If you have any questions, I'm more than happy to answer them. And hopefully I didn't confuse people with my horrible accent.
Okay. Well, thank you, Todd. That was a lot of great information. And you presented it very well. I had me chuckling a few times. So a few questions came through. This one, I think you just answered. How often do you recommend updating your buy sell? 1.5 years, what you just said. What's the process to change your buy sell in the instance of a divorce or incompetence, for example?
Yeah, divorce is another, it could be another triggering event. So could bankruptcy or a loss of license, like a dentist or a doctor. So those could be a triggering event. If they're not, and you want them to be, you'd have to amend the buy-sell agreement to put it in.
Okay. And so that was a question too I saw on the chat. Can personal bankruptcy affect implementation of a buy-sell agreement?
It can, if you have it in there as a triggering event. Vast majority of buy-sells we will see will say death, disability, retirement. The really good ones that really get into the details will specify bankruptcy, divorce. Some states will have it where they have the spouse sign off, acknowledging that the buy-sell is there, and that is a provision.
Okay. Another question. You said earlier in the presentation, depending on what happens with the state tax rules, what do you foresee happening to estate tax rules?
I'm not the person to answer that one. I'll give a quick story. Prior to the 2011 rules coming into play, I was on the roadshow and we were told with absolute certainty from the lobbyist in DC, you will never see 5 million as the exemption, never. Lo and behold, you saw it, it came into play. I don't know. October, November of last year, there was a lot of stuff coming out of House Ways and Means and then went up to the president. on all different ways of attacking estate planning and exemptions. The one that was getting kind of the most favorable view was taking the rules the way they are today, where they shut down in 2026 and go back to the old exemption, which is going to be about 6.5 million, is to fast track that up to today, which would have been 2022. So instead of going to 3.5, which was some of the scuttlebutt, going to 1 million, they just said go with the rules that were in 2011, which was 5 million plus indexing, and fast track it to 2022. None of that passed. With all the things that are going on nowadays, and trying to pay for things, I couldn't tell you. It's too chaotic right now to give you a clear picture. But will the exemption based on current law go down? Yes. 2017 Tax Act says it goes from 12 million and growing down to pretty much in half, and that's in 2026.
Okay. 2 more questions. Best way to value a company when being bought out?
Yeah, great question. You go out and get a third-party appraiser. In essence, if you're really looking to sell, and we know our owners will over or underestimate by as much as 60%, then going out and get a qualified appraiser helps certify what that value is. And then that way, if something happens, you're going back on their insurance in order to cover the damages.
Okay, and last question. Since you are a New Englander, are the Celtics going to win it all?
I hope so. Here's the funny part. I'm not going to use the word. I do not support the Red Sox or the Patriots. Growing up in Western Mass, if people know, the only thing that was on in this area was New York Jets and the Yankees. So that's what I grew up on there. However, growing up for basketball and hockey, it really was the Celtics and Bruins. That was all that was on. So yes, the Bruins broke my heart. The Celtics are doing phenomenal, knock on wood. I'm very hopeful that the Bulls don't ruin my rest of my season. So yes, go Celtics.
Okay. Well, wonderful. Well, thank you so much for joining us this morning. We really appreciate it. Just a reminder for the group, the session was recorded. We will get that posted on our YouTube page later this afternoon or tomorrow, and Megan will send that link out. Please feel free to review it or share it with someone who you think would find the information valuable. If you don't follow us on social media, Facebook, Twitter, LinkedIn, we're on everything. I believe Megan live tweeted this event, so feel free to follow us, like us, share everything, help us get our content out. This wraps up our sponsor mini forums for the season. We'll start back up in September. The center does have some fun events coming up. If you didn't know, we are just celebrated 30 years in April. So we've got a lot of fun stuff going on throughout the year. We will have our large celebratory event in November that everyone will be invited to. More information will come out on that later. And if there's any golfers out there, we have our annual golf outing on September 19th. We'd love for you to get a team together. We have some sponsorship opportunities available. Proceeds go to help fund our newly formed or rebranded, our Family Business Student Association is rebranding to an Entrepreneurship and Innovation Club, and it goes to help student scholarships as well in the entrepreneurship, family, and small business field. So love to have you. Feel free to reach out to me, Megan or Kirsten, if you'd like any information on that. We do have a webinar coming up in June 16th, I believe. Invitations went out the other day, and it's on our website. We partner with an organization, Family Enterprise USA. They recently did a large survey of family businesses across the country, which some of our members participated in, just the landscape of how things are in the family business world right now, and they will be sharing the data that they received from that. So again, that's on our website. Feel free to register for that. Hope everyone enjoys this gorgeous day. Thank you again, Todd. Thank you, Skylight Financial Group. As always, we appreciate your sponsorship and your expertise. So, enjoy the day, everyone.
Have a good one, everyone.